We are looking at an Australian US dollar weekly chart, and what we're going to do is we're going to look for some position trades. Now, back in 2001, the market went into this pennant for about 9 months, almost 9 months, and then it broke out of the pennant and it moved from 52 to about 57. Price came back to test its highs, the pennant highs here. Nice candlestick formation, and then started to move up. Went into a very tight range for a couple of months. Keep in mind that this is a couple of months, all right? And let's look at the price range. 56.81 to it's about a 100 pip range. Probably 100 to 150 pip range, this area. Then we rallied and continued to rally up to 80 cents and reversed. And let's start to move forward. We had a nice bounce off the previous reference highs at 68. These are all position trades. Testing the pennant, the high of the pennant, breaking out of a range. Tweezer bottom here might have been a pretty good trade. What you would have done is you would have just a break of trend lines on longer term charts are quite handy. Break of the trend line, position trade. The challenge for most traders is when do you get in, right? Because it breaks out, then you feel vulnerable or you feel exposed. Well, you have to use a bigger stop. And if you're risking 1.5% and you're using a bigger stop, then you'll have to use a smaller position size for that trade. Or you can just simply trade unleveraged, trade in cash unleveraged through the bank is usually a good idea for these types of trades. So price comes back and works its way down in a bit of a consolidation. Now price comes all the way back up, and unfortunately it reaches a high of 79.52, and the high here is 80.03. It's 50 pips off the high, which is too bad because I like it to get closer to the high for a trade. Then price starts to come down. Now it comes to 80. Okay. Here's your trade. Position trade right here. If you want, you can wait for the break of the trend line. Now it breaks the trend line. This was a well-respected trend line here. 1, 2, 3 strikes, and then it breaks through. Now, if you enter the position trade here, you would have to endure these swings, and they're very, they're very deep retracement swings. Price comes down to these highs here. Support, resistance, support, and then breaks through. A deep retracement. We jumped the gun on that one. Now, as we start to get into a deep retracement, on each of these retracements, we can use our Fibonacci tool. But let's use it on the most recent swing from this high to this low. The market comes up and bounces Actually, on a daily chart, you can see it quite clearly. You can see the bounces on the retracement at each of the Fibonacci levels. And we come right up to the 79% level, very close to this high. Very similar also in timing to the British pound retracing to the 79% level. Then we have our move down. So it's from 78 down to 73, a 500 pip move directly from the 7800 level. So here we have countless position trades. Price forming a bottom here. Support becomes resistance here. Price moving through resistance and rallying. Test of the highs. In here, you'd have to go down your daily charts to see what's available or what came to fruition. Let's walk through the daily chart scenario. It's we can maybe see some of the bounces here. Not really. We can see the weak highs. Here's what your bounce at the 79% retracement looked like on the daily chart. Now, knowing that this is a key level, you would look for your short in this area. Now, as it currently stands, we're in this nice downtrend, and I hope the Australian dollar continues to weaken since I'm going over there. Sorry, Aussies. It can rally after I leave. In any event, our next position trade, we will look for a bounce at a key level and a break of this trend line.